Today's task is to decode the economic data here in the United States of America. Now, the reason why we have to decode it is because it's full of manipulation, lies, and just downright fraud. But Wall Street doesn't care. The stocks are pumping back up here again today. Oil has fallen off, and that is a key signal of the recession that is looming. I argue we're already in one. If you look at Main Street, if you ask the common person walking down the road how they feel about the economy, it's bad. And oh, by the way, that's confirmed in the data. I'm doing my best to come on here and not just throw out how I feel about something, whether or not I think something's going to go up or down, but explain why with true analysis, fundamental and technical. My name is Zach Rector, and what I do here is I break down current events, financial markets, and how I'm taking advantage of the greatest transfer of wealth in world history. If you're new here, all I ask is that you tap that thumbs up and that you share it out far and wide. After you make sure you subscribe, hit that notification bell, because you're not going to want to miss any of our updates. Now let's get right on into this data. Of course, I mentioned the manipulation and the lies, but what's also hilarious is the cheerleading. So on Monday, we start off with the monthly U.S. federal budget, and it was an actual deficit of $67 billion versus $70 billion. So not quite as bad. Everyone cheer and clap along. And that was because Californians got an extension on paying their taxes because of their winter storms. And so with a little bit more taxes being paid from the Californians, the U.S. monthly budget wasn't as bad as forecast. So congratulations, everyone. Now, we did get the CPI coming in on Tuesday. We were all waiting for that. And that was the big one that came in and really started this stock rally to continue back to the upside. Now, CPI year over year was at 3.2%, core coming in at 4%. Remember, the core is what they're trying to get down to 2%. So there's still a long ways from achieving that core back down to 2%. But the headline CPI of 3.2% had the market rallying because basically the expectation, the conclusion to take away was that the Fed has won the fight against inflation and they're done raising interest rates. Now we can start to look forward to cuts. Daddy Powell's going to take it easy on us, and let's pump the stocks. And that's what's happened all week here. Meanwhile, when you look at the real data, it is not good. U.S. retail sales falling off. This is Main Street spending, right? This is the consumer, and this is the largest driver of GDP here in the United States. So the consumer is falling off. Your U.S. retail sales fall off. Empire State Manufacturing Survey was actually strong. Okay, so we do have a little bit of an uptick in that. That was interesting. But then we got some more Fed speakers coming in. And then today was the big one. We come in here, and on today, we get the initial jobless claims, which beat expectations. Not good, right? And then we got that home builder confidence, which was worse than expectations as well. I'll be diving into that here shortly. Now, the cryptocurrency markets, where we're trading at right now, is 36,149 for Bitcoin. We were back down to 35,500 today. Ethereum at 1964. At the time of this recording, it's about 2:30 on the West Coast. That's going to be 5:30 Eastern. So the markets have closed for the day. Cryptocurrency obviously going 24/7, 365, as all markets should be for that matter. 61.5 cents for XRP. And so, like I said, we're watching this thing right now. Here you go for your charts. Bitcoin was back down to 35.5 today. Quick back test. Okay. So basically everything fell off today besides your stocks. And I'll show you that here in a second. Ethereum back down 1965, XRP back down to 61.5. And your DXY was back up today after coming back down here to about 104. So the DXY absolutely fell off. And why did that happen? That was because our CPI, the inflation came in low. So basically the dollar will not be strengthened anymore by the Fed raising rates. We're about to get the easing is what the market's expecting. And so the dollar index fell off. Now, what was so concerning for me about when the DXY fell off earlier on Tuesday after we got the CPI report was that crypto didn't pump. That was the bad news, right? Stocks were going up. Risk on assets like stocks were pumping and crypto wasn't. Now, normally, crypto is correlated pretty closely with the stocks, and we should have seen, a crypto pump. We didn't get it, and that was very concerning for me. And once again, I'll provide further analysis in another update here today on the crypto markets. We did confirm, by the way, that R3 is using XRP. That's from David Schwartz. I'm going to be dropping that video here later. And then we're going to be going live here tonight also. So make sure you guys stay tuned for that one. But back to the charts here, you can see we had the treasuries fall off here on Tuesday as well with the dollar index, and they continue now. A little bit of a rally here today. Okay, for the 2-year and the 10-year, a little something. And then we saw the oil got killed today. Oil got killed today, back down to about $76 per barrel. And this is your Brent crude oil. Okay, so this is the worldwide benchmark. And then we saw that silver and gold did rally. I forgot to mention that. Earlier this week, when stocks pumped, the only other things that really pumped with the stocks was gold and silver. So we absolutely did love to see that silver back above $24 per ounce earlier today. How about that, folks? To start the day, silver going back above 24 bucks. Love to see it. And gold back up to 1988. Strong move for gold this week. Back up here, holding really strong. Now, like we said, the stocks moving up. Nvidia back up to basically all-time high, approaching once again $500 for Nvidia. 496 is where we finish off the day at. 4,500 for your S&P 500. This thing has been rallying the last 2 weeks, very strong. Same thing for your Dow Jones Industrial, back at basically at 35,000 here today. And then we see that the total cryptocurrency market cap did fall back off to 1.3. Recently, we did just top off here at about 1.413 trillion. 1.4 trillion for your overall cryptocurrency market cap. Now, Bitcoin dominance has remained strong. Remember, it really topped out there at about 53.5, still here at about 52 cents. And so a flight to quality is underway, right? And I argue that folks are going to be coming to XRP here soon, but I'll be talking about that in another video later today. Now, as we were saying here, the data that came out today is in this week is good for the suits, right? They get a cheer that they won the fight against inflation. When you look under the hood, right, when you look at what's really taking place, it's not that good for Main Street. In fact, some would argue it's pretty bad, right? And so we're seeing that retail sales are falling off, consumer spending's falling off, the job numbers that came in today, not good, and the home builder confidence, not good either. But I wanted to show you this tweet right here from Michael Gayed, CFA. Oil is doing what it does prior to credit events. Oil is doing what it does prior to recessions. I will not relent. And what we're seeing is there's terrible data coming out of China right now. And this is a global economic recession that's taking place right now with demand falling off worldwide. This is why we're seeing oil get beat up, and folks realize, even Walmart's CEO talking about deflation in today's earnings report that was shared. And so when you got the D word coming out, right? Deflation, that is a terrible sign, terrible sign. And so what we see now is oil is falling off because folks see that we're entering a recession. There's going to be less demand for oil, less demand because we're going to have less of a moving economy. That's what that data point is telling us. Oil, a really good indicator of kind of where things are going, along with the bond market as well. Now, let's continue on here, folks. I wanted to show you this. This is the front page of Bloomberg today. Fed-friendly data lists bonds as S&P 500 waivers. Markets wrap. Continuing jobless claims climb. Factory production declines. Oil sinks below $73 as algorithms amplify supply-driven drop, i.e. they see the recession is here. And remember, folks, they've already said, OPEC has said that they are going to continue the production cuts into next year. So they're continuing to cut the production, yet the oil price is still falling off too. This is not a very good scenario playing out right now. Treasuries climbed after the latest economic figures underscored a gradual slowdown, reinforcing speculation the Federal Reserve will end its most aggressive hiking campaign in decades. It's the most aggressive hiking campaign. It was the fastest rate hike in history. 10-year yields fell 8 basis points to around 4.45 following a rally that sent stocks near overbought levels. The S&P 500 was little changed. Walmart slumped amid a cautious tone on the outlook for consumers. Yeah, after your CEO admits that prices on their goods are going to have to be cut here soon. We're going to see deflation. Walmart slumped today. Absolutely. And oil tumbled below $73. Now, I want to show you guys this article here next. The jobless claims climbed to 3-month high of 231,000 and sign labor market is cooling. So while everyone pays attention to the stocks pumping, right, what's taking place on Main Street? Less job hiring, right? Jobless claims coming up here. And this is a 3-month high, beating expectations, and layoffs appear to be creeping up, and the unemployed can't find jobs as quickly, right? So It's getting rough out here. New jobless claims climbed 13,000 from a revised 218,000 in the prior week. Okay. And claims still show a very low number of job losses and indicate the economy is stable, but businesses are hiring less and the labor market appears to have cooled off a bit. Well, that's just a leading indicator, right? If they're not hiring new people, that's the start. But then eventually it ends up with laying off and firing the staff that you do have if it gets tight enough. And I believe that that's what we're about to see. Now, the other data point that I wanted to share with you guys is the home builder confidence falling off here for the fourth month in a row. Not good. Builder confidence fell in November for the fourth month in a row in the face of weakening buyer demand as mortgage rates reached 8%. Builder confidence fell to the lowest level since December of 2022, which pushed the National Association of Home Builders monthly confidence index down 6 points to 34 in November, the trade group said on Thursday. They had also ramped up sales incentives to boost interest, with the share of builders cutting home prices to the highest level since November of 2022. So the builders have been offering the incentives and they've also been cutting prices. But builder sentiment may likely improve in December as rates fall and the U.S. economy shows signs of weakening with inflation moderating. Well, I would argue that if the builders think that it's going to get strong and that this is good, just because we're expecting the rates to fall, right? I think that they fail to miss and understand the true recession that takes place after the Fed starts to cut rates. Every time you see the Fed go on these hiking sprees where they raise rates up and then they flatline, okay, the market rallies during that time. That's what's taking place right now. And then when we start to cut rates, that's when folks realize, okay, this is it. And that's when we start to really enter that recession, get the job layoffs, and we will see the equities correct at that point as well. So, if the builders get faked out in December, well, I wouldn't be surprised. Because I'll tell you right now, what I'm seeing is many builders are caught holding the bag, and that's why they're dropping the prices on these homes and especially the commercial properties as well. The November figure fell short of what economists were forecasting on Wall Street, which was expecting sentiment to remain unchanged. A year ago, the index stood at 33. So we're right back to where we were last year. And the share of builders cutting prices to boost sales rose to the highest levels since November of 2022 to 36%, said the National Association of Home Builders. So 36% of builders are cutting prices to boost sales. The average price cut was 6%. About 60% of builders were also using incentives. So 36% are cutting prices, 60% are using incentives, which is another form of price cut at the end of the day, other than price cuts to improve sales in November, right? And this is a big part of why that median home price in the United States hasn't fallen off too hard yet either, is because they're offering incentives to paper this thing over, right? Instead of, cutting prices is the last resort. First, they would prefer to, give you some incentives. The National Association of Home Builders also said it was forecasting a 5% increase in single-family starts in 2024 as financial conditions ease with improving inflation data in the months ahead. Well, that's where they miss, right? Whatever economist from the NAHB who's saying that financial conditions are easing with improving inflation data in the months ahead is getting set up for failure once again, right? Maybe they're best buddies with Paul Krugman, CNBC talking heads, who come on and say that the Fed has won the fight against inflation. It's the same message here that they're saying, and they're going to get set up. The three gauges that underpin the overall builder confidence index fell. Builders were pessimistic about current sales condition. The gauge fell by 6 points. They were downbeat on future sales. The gauge fell by 5. Builders were also seeing a drop in the traffic of prospective buyers. The gauge fell by 5 points. Now, mortgage demand is at the lowest level since 1994. Who's confident about this market right now when we see that mortgage demand is the levels that we haven't seen since the early 90s? That's bad. It's not good. Rates inch toward 8%. That's your mortgage rate. 8%. Can you swing $3,000 per month for your median home, your cookie cutter in the new development where you can reach out your window and shake your neighbor's hand? That's going to cost you about $3,000. And for many of you guys, you're seeing it, right? That the affordability is at the worst level that we've ever seen. That's the truth about the mortgage rates right now. Now, rates inched towards 8%, spooking buyers who tried to amp up sales by cutting prices, offering more generous mortgage rate buydowns, and more. And I would argue right now, I've been telling my community folks, if you can take advantage of these builders, go beat up the builders. Go get those incentives. Go get those lifetime rate buydowns, right? The mortgage rate's at 8%. There are some builders, that are willing to offer you basically 5%, 4.5%, 5%. Permanent rate buy downs because they're so desperate to get these homes sold. But with rates falling back to the 7% range, builder sentiment may improve in the months to come as buyer demand recovers. Well, the lack of the inventory is going to be the problem, right? And the lack of inventory across the nation will also keep buyers interested in newly built homes since existing homeowners feel little incentive to sell due to the lock-in effect. So the rise in interest rates since the end of August has dampened builder views of market conditions as a large number of prospective buyers were priced out of the market. NAHB Chairman Alicia Huey, a custom home builder and developer from Birmingham, Alabama, said in a statement, while builder sentiment was down again in November, recent macroeconomic data point to improving conditions for home construction in the coming months. And this is Robert Deitz, chief economist at the NAHB. Now, like I said, if you want to put on the bullish blinders, then we can do that. That's what I said in relation to the equities markets, and I'll say the same thing in regard to the home builders too, right? Now, the opportunity here is to bring affordable quality housings in quality neighborhoods. There still is a shortage, right? But we are seeing right now in some cities, a flood of new supply is coming online. So there is going to be a reset. I'm not going to give you a general market goes up, market goes down. Commercial real estate is already getting sacrificed. And whenever I bring up the real estate, I really like to segment it out. Residential, commercial. Residential markets around the country are still going up, okay? So I'm reading off in this and I'm giving you what is relatively a bearish take, right? But at the same point, I recognize that there are some markets where prices are still going up. On the flip side, commercial values are down 15 to 30% on average for apartments and new commercial properties, and office space is down 30% plus 50% or more in many markets. So commercial's already been sacrificed. Let's be very clear about the real estate market. Commercial has been sacrificed. Commercial has been killed. We might as well just blow up some of these office buildings. I mean, it would be faster, easier, and cheaper to demo them and restart fresh to build apartments than to try to convert them over to something that we actually need, which is affordable housing. And so you're going to see the builders are really moving the market right now. And that's why I've been watching the builders so closely, is because when the builders are saying that the traffic's falling off, when the builders are offering more incentives, when the average price cut is 6%, right? 30% are offering price cuts and 60% are offering incentives. What does that tell you, right? To move a house as a home builder right now, you are cutting price or you are offering incentive, period. Now, if it's priced right, good neighborhood, it's selling, right? There are still markets going up. Residential real estate is still hot as can be in the suburbs outside of these cities that people are trying to flee, right? But I don't want to go too long with this update. I wanted to just decode some of this data, tell you where I'm at with the equities, with real estate, what I see coming for crypto. I'm going to be dropping another update here later today, so make sure you stay tuned for that. What I'm trying to do is to decode this data so that you can understand my investment thesis. Remember, I'm not day trading. I only take fundamental positions, and the tightest, shortest trades that I will ever do is a swing trade that maybe is going to be over a couple days to a few weeks, right? So I'm not a day trader. I'm not trying to be in and out of this thing. I'm in fundamental positions, and I'm just trying not to lose my shirt in this market that I think is setting up a lot of people to get comfy again when that's the last thing that we should be doing. I encourage our audience to lean in right now to establishing a team, relationships around us to move within our business, our investments. If you want to get tapped in with our community, that's at my website, zachrector.com. Join Patreon, get access to Discord. We are now offering one-on-one sessions again. So if you want to get on the list for that, it's all over at my website. I appreciate everyone for stopping by, and I will see you guys in the next update. God bless you all.